Hi everyone, we're going to start off this week. This is a new module and we're going to go over primarily chapter 13, but first I wanted to review last week and go over the homework. So just so you guys know, these are all as well Roger CPA questions. They partner with the publisher to have them included in our book through Connect. So I encourage you all to practice these because this is what the multiple choice will look like on the CPA exam from this topic. So let's start with number one. Which statement is true about reporting unrealized gain and losses from available securities? Available for sale securities, and this is unrealized gain and losses from available for sale securities should be reported as a component of income from continuing operations if the fair value option to report these securities is elected. So in this situation, when you have an option to report all assets at fair value, and then they just go under unrealized gain and losses, right? Now, under the fair value option, securities are reported fair values, right? If they don't select the option, then it would go to OCI. So this comes up a couple of questions because I'm assuming this is a hot topic on the exam, right? CAP has a portfolio of debt securities that it doesn't intend to sell in the future, but is not sure what will do with these securities. CAP does not elect the fair value option to report these securities, which below statements are correct. They should classify as available for sale securities and report unrealized gain and losses as a separate component of other comprehensive income. So they don't elect the option, so it does go to other comprehensive income, and they report it as an OCI. If they did elect the option, obviously it would go just to income. Next question, we have Rock Corp with tracking their available for sale security, and the question asks, by what amount should Rock increase its 2018 other comprehensive income, right? And let's see here. And I believe the question actually meant to ask what amount it would increase if it was the 2019 other comprehensive income. So I will update that on the homework, make sure everybody gets credit. So because it says here it's going, assuming that with the question asking if this is 19, not 18, then going from 65 at year-end 18 to 90 at year-end 19, it would be 25 would be the difference, right? And then the next question asks, what would it be in OCI if it doesn't elect the fair value option, right? What would it be in OCI, period? What would be the balance of OCI? So the first year, it would go down by 15. The next year, it would go up by 25. So the total amount of the OCI would be 10,000. So that's how we get there. That's assuming nothing else hit that account in the situation. Which statements are true about reporting debt securities held to maturity? So it's reported amortized cost, as we discussed, which means using the discount premium or discount or premium and amortizing that. And it means that the market value must be disclosed in the notes, right? So unrealized gain and losses are not recognized in income. If it's held to maturity, no recognition of income occurs. SORC has a portfolio of debt securities classified available for sale at the end of the year. The fair values of the securities had increased relative to their balance at the beginning of the year. How should SORC report unrealized gain and losses on portfolio of debt securities and statement of stockholders' equity? Right, so if this is available for sale security, okay, so only the cumulative amount. So a correct journal entry to report unrealized gain and losses would include an increase to other comprehensive income. So they had income on the security it's available for sale, so it goes to OCI. And since it's just for the year, one journal entry updates it, okay? And this is going to be an OCI, so it's 3 only. Moving on to 7. At the end of year 1, Rome Inc. held debt securities classified as available for sale, and the carrying value is 57,320. That was there was a loss there. What was the cost? So you add them up, and the sum of the two is 69,670, and that's how that cost minus the loss would equal the market value. And for 8, we had a question of, at the end of 2018, Shore Co. held trading securities at 17,500, and which had a year-end market value of 19,000, and then it was sold in 2019. But for the year-end 18, you have to really keep track of the years here. For 18, what should be the gain? So that's just 1,500, because it's just increased from 17.5 to 19, which is 1,500. And here for 9, same question, but what would happen in 19? And then you go from market value to market value. So 22 minus 19 is 3 in this case. And the last question, Ms. Co purchased the following securities during 2010 to be classified as held to maturity. Trading securities or available for sale securities. So which above securities should be classified as available for sale? So available for sale, that's securities that they want to resell in the future. That's going to be trading. U.S. Treasury bonds that they want to hold to maturity, that's held to maturity. And an investment in stock that MISC does not intend to sell in the near future. The equity investments are classified as either fair value through net income or as equity method investments. So this one doesn't basically include as well. So none of the above. The only question is 3. I think this is, since it's an investment in stock, it's not a common stock purchase. They're saying that kind of equity investment is either fair value or net income. So basically they're saying that it's not available for sale as well. So this concludes our homework review, and I will post this as well so you have this file and you can look it over.